Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, volatility. Since volatility is such a huge topic here, and especially in these markets today, and you know the Dow moving another 4% today, I want to define volatility because I don't think a lot of people do a good job of just flat out defining it. And to talk about it, I want you to really get a good grasp as to what it means when a marketplace is implying a volatility of a certain level. So the two main terms that you need to grasp are historical and implied. Historical volatility, and this is a very important point, historical volatility is the annualized standard deviation of the past stock price movement. Right in this definition is annualized, and another thing is standard deviation. Now, this is what if you open up the Webster's Trading Dictionary, this is what you would see in the dictionary. And it always implies that if you see a volatility where it says 40%, all right, that is going to be based on a one-year basis. That means that they've gone in each day, looked at the high point of the stock and the low point of the stock, day in and day out, every day, 256 trading days in the year, and they determined a volatility based off of the high and low of the day. So a stock could actually be volatile. You could say, well, the stock was trading at 100 on January 1, 2008, and on January 9, 2009, or January 1st, 2009, the stock was at 100. Now, is that a volatile stock? Well, it could be. You need to know a little bit more information because if the stock during the year more than once traded as high as 250 and as low as 25, and it did that about 4 times during the year, that in itself would make it a volatile stock. So it's not necessarily the high and low of the year, it's the high and low for each day, each period of the year. Now, the big number that is often misunderstood is implied. Implied is the volatility that justifies an option's current market price. It's also stated as an annual number and can only be found using an option pricing calculator. Okay, so the reason I always kind of start this off because a lot of times people will go out and look at volatilities and they'll ask the question wrong. They'll call up and say, well, what is the volatility of the IBM option contract? And if you think about, or they'll say, what's the implied volatility on IBM? And if you think about it, you're really asking the question wrong. But most brokers will know what you mean. But when you say, what's the implied volatility on IBM, if there were no options, there would not be an implied. So think about that for a second. If there were no options, there would not be an implied number to quote you. So when you call up and you say, what's the implied volatility on IBM, I'm going to actually toss in a TradeKing chain here. There are many different strikes. We got January call options on IBM. There are many different strike prices, as you can see by my mouse, and there are many different implied volatilities for each and every option contract. So what do they quote you when you call up your broker? Well, the common practice is to quote the near term, most at the money, which would be the 85 strike here, option contract. And here we'd see the implied volatility is 48. Now what they'll do a lot of times, if they're just quoting a general vol and you haven't stated what option you're looking at, is you'll quote an average between the call and put option to kind of get a weighted average. So I'd probably say if you called me up and said, what's the implied volatility on IBM, I would say the implied volatility is 46%. Somewhere right in the middle between the call and the put implied volatility. All right. Now, there's a general skewing of volatilities, but the general consensus is that this is usually the most heavily traded option contract. This is where most of the monies are coming in, right here at this option strike, and you can see this with the open interest. This is where most of the open interest is, right in between the at-the-money option contracts, and that's also usually the case over on the put side. See where a lot of that open interest is right around the at-the-money option contract. And so once we figure that out, we will actually tell you what the marketplace is implying. Now, it's also stated as an annual number. So even though we quoted a January implied volatility, it's stated as an annualized number. All right. So when you look at implied, and this is the reason why we want to understand that. Now, we're going to use it a little bit when we're picking our butterflies, when we're looking at different trades, and even if we're doing, I'm going to look at different instances where we're looking maybe at doing a credit spread, where we're selling a call credit spread because we want the market to go down, or selling a put credit spread where we want the market to go up. If we're looking at those different trades, understanding this concept can help quite a bit, and across the board. Implied volatility will let you take the math of the marketplace and use it in your trading. Okay, so I know I'm speaking a little fast, and slow down. If you have any questions, I hope that everybody's kind of keeping up here. I can actually take a peek at the questions and see how we're doing.
But we're good.
We're doing good. Okay. So if I'm going in and I'm looking at the different option contracts, and I have an implied volatility, a lot of people will come on out and say, well, the market makers are setting the implied. And with that, I always I kind of get a little bit nervous, because when you think about it, when you look at an option contract, it's always what comes first, the chicken or the egg. Are the market makers setting the implied, or are we setting the price? And most of the time, the supply and demand will take over. So if I'm looking at buying option contracts on that IBM contract, stocks trading at 85, and everybody's coming in and buying, when you place your order to buy that option contract, let's say major news has came out on IBM and everybody is buying it now. It's all good news. And they keep buying and buying and buying, all right? Now, when that happens, what will happen is the price of the options will go up independently of the actual stock moving. Now, how does that happen? Well, the market makers are, quote unquote, raising the implied volatility. But why are they raising the implied volatility? Because you guys are telling us that the stock's going to move. And so each and every time that you buy and you buy and you buy, the market maker is getting shorter and shorter and shorter. What do they ultimately want to do? They want you to stop buying, right? So they raise their price of their option contract until it gets to a point where you say, all right, that's got too much, quote unquote, to use the technical term, right, juice in it, too much option premium for what I think the market can move. So hence, I'm not going to buy it. Not only am I not going to buy it, I might turn around and sell it because I think it's overpriced. All right. Now, when you do that, or when we as individuals in the marketplace do that, we're saying something about what we think IBM can move. And that number is translated into an implied volatility. So when I said that we're going to use the math of the marketplace, that's what we're talking about when we say implied volatility. That is some way to show, in an odd sense, the line as to what the marketplace thinks IBM can move over the life of that option contract.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.